It has been a week since Donald Trump's election victory, and markets rallied after the results, but have since pulled back a bit as traders digest the implications of Trump's policy ambitions. Here with his take is Michael Craig, head of Asset Allocation and Derivatives with TD Asset Management. I have got a long list, a very long list here of all the things, and I would love your help in helping me parse maybe what's more important and what's not.
Let's go. Yeah,
okay.
Sounds good.
So let's just start with markets. We're near all-time highs. We had a Fed cut too. Maybe just give me your sense of where we are in the markets just to start with, and then we'll get into the implications, because pretty buoyant.
Yeah, a lot going on. Massive diversion between U.S. markets and the rest of the world. So even though it's been a lot of green in the U.S., it's been quite weak in Europe. And the market's pricing in a very different agenda that would have been had Harris won. So that's early on. I think there are certain things that have been overshot a bit. I think the fixed income move is a bit overdone. I don't think rates really deserve to be this much higher. But look, there's a lot of euphoria and a lot of capital that was waiting to do something that's kind of moved all at once. So it's pushed things quite a ways in the last few weeks. I would expect to see a bit of moderation now for next few weeks.
It's interesting too, just to make that distinction as you did, that yes, U.S. markets are buoyant, but when you think about European markets, I mean, there's a lot of worry about what could happen out of this next presidency for Europe and the rest of the world.
And there should be. Like, if you watch since the election, the Trump transition team has been very clinical about posting people for various executive positions. They're not middle-of-the-road people. They are full-on MAGA. And so I think it's fair to say that we should expect to see tariffs as one of his first objectives, and that will come as early as January, if not February. So countries that depend on U.S. consumption to meet their growth model are going to be under a tremendous strain to rebalance and figure out how they're going to grow in absence or with the headwind of tariffs in the U.S. market. And
a strong U.S. dollar and, right?
Absolutely. And so, if you think through it, if we're running Germany, for example, the elements of growth, they're going to have to figure out how to either increase consumption or investment or a mixture of both. And so I would expect to see much more debt issuance or fiscal deficits in some of these countries in order to stimulate both consumption and investment. And I think this is going to be, I don't think the market's really paying attention to this yet, but we all look at the U.S. fiscal deficits as a problem. But I think that story is going to start hitting countries running large current account surpluses or trade surpluses with the U.S. because they're going to have to figure out another way to grow. And there's no other market in the world where they can kind of export to make up for lost U.S. consumption.
Which just sounds to me more like spend, inflate.
Spend, cut taxes, investment. There's certainly some certain areas that have been needing infrastructure investment. So this is probably a good time to do it. And so it has implications. It has implications for commodities. It has implications for inflation. And bond rates, government bond rates across the world, not just in the U.S.
Okay, let's start down the list. You mentioned some already. Let's start with trade and tariffs. I guess this is going to matter by exactly how, who much, when. But we know that obviously that been very vocal about China, and that's not a big surprise. Mexico, not a big surprise. What are you going to be listening for as this evolves over the next little while?
Well, you have to start with your base case and then work from there. Yep. I would expect to see tariffs on China day one. There is a bit more of a sanguine view that this is all just a ploy to get China to the table. I think they tried that the first time around and didn't really get anywhere. So I think they're going to go in hard day one. It's hard. There's the policy and then there's the execution.
Right.
That is not trivial. In terms of Europe, was probably number 2 target. I would expect to see 5-10% tariffs on European goods. In terms of North America, we get a bit of a pass until 26 when USMCA will get renegotiated. Doug Ford was in the wire today saying we should really separate Canada and Mexico from these negotiations, trying to create more of a NAFTA or just a US-Canada feel to it, if you will. But there'll be a lot of politics and a lot of back and forth. And fortunately for Canada, even though we are running trade surplus, we buy a lot of high-value goods from the US. And so we do have at least somewhat of a, leverage is probably too strong a word, but we're not going in without, there is major implications if you go hard on Canadian goods because
the U.S. loses.
Yeah.
So we've got a more balanced, I guess, trade table.
Far more enviable position because of the two-way trade, if you will, versus countries where there's a huge, and there has been prolonged trade deficits, and those are really areas that the Americans are going to target.
Okay, I feel like each one of these is an hour conversation, but we're going to, keep moving. Tax cuts. Obviously campaigning on the fact that he wants, some relief on either to continue the relief you already put in place or to increase more. What do you see there?
Yeah, so there's Trump's original 2017.
Yes.
Those get put into law. I don't know if you're going to get a whole lot more.
He campaigned on cutting income tax.
Yeah, he did, but they're going to have to figure out where they're going to balance that on the other side. I mean, I think at the end of the day, at the heart of Republicans, they don't want to blow out the budget deficit just on tax cuts. So I think we're going to be, I'm not saying it's not going to happen, but I wouldn't say it's a guarantee. And I think you're going to have to see what he does on the other side of. If they actually, entitlements I think are on the table here. So if they actually start to see them going after kind of the sacred cows of their budget, with Medicaid, Medicare, then maybe you get personal tax cuts. But I think a lot of pieces have to start moving before you see him go to tax cuts. So I think the 2017 cuts for sure get put in law. Everything else I think comes with a caveat that they're going to cut somewhere else to have some, at least not do any more damage to their budget deficits.
The one thing I think that probably people are not, maybe some are weighing this as much in the markets, is that, whatever changes that are made in the U.S. to the competitive landscape, trade, tariffs, income taxes, other countries are going to have to do things to balance so as not to lose capital or people. What else do you expect to see in other places? Do you expect there to be
depending on how those economies are set up and how quickly their political systems can adapt.
Yeah.
I have a hard time seeing Europe kind of roll back the kind of regulatory bureaucracy that they've got built out. But
Canada?
Well, we are, months away from an election.
Yeah.
So if you go with where the polls are now, we're going to have a change in government. I think you could see pretty radical changes in terms of how we roll and probably some areas where we start to match what the Americans are doing. But that's, again, things can change in a heartbeat in politics, I'm just saying, but that's something to be thoughtful of. I think there is pent-up demand here, and perhaps with some changes in tax rates, you'll see that unleashed. But again, you have to see the politics play out first.
Industrial policy. When we think about, what the States is going to focus on and what the president and his administration, Elon Musk will not be part of the cabinet, it doesn't sound, but he's certainly influential. Does that matter?
Oh yeah, absolutely.
Why?
Well, I mean, first off, in terms of industrial policy, deregulation will be the term du jour. Rolling back subsidies for green industry, allowing fossil fuel companies to drill, rolling back kind of the guardrails around AI are going to be key topics.
Which has inflamed the markets. I mean, they're thinking about all these M&As that could happen and just lighter touch.
Yeah, but also, in that kind of world, with limited regulation, you do get more progress.
Right. I agree.
But you're going to have more errors along the way.
Yeah.
And so it really creates, the outcomes are quite wide now in terms, because AI is such a impactful technology and it can be used to create great things, but it actually can be used for quite a bit of damage too. So that does create a lot more volatility in kind of the world, society as a whole. On the industrial policy side, again, there hasn't been, we've had a nice stock rally in the stock market. It hasn't been all sectors. Any sector tied to democratic policy, cannabis, green tech, solar, have all come off quite hard, except Elon Musk's companies. So that's where the big change is that you don't have those subsidies anymore to support green industry. But you've got a ton of deregulation, so that's been great for financials, energy, et cetera. Been bearish for commodities near term just because the permitting will be easier, but I don't think that'll be a long-term trend. And so that's kind of where, this is not a kind of one-day thing. Maybe you get the markets cool down a bit. This will be a keynote for this presidency for the next 4 years.
And I think that's maybe what I'm more curious about, because we've seen a huge run-up. So some people are thinking, did I miss it, if they weren't already in it? But I mean, how much volatility do you expect over the next little while? With so many cross currents, you have to see some. Well,
we've priced in all the kind of what people perceive as good things.
Yeah.
We haven't really merely priced in what could go wrong. Like tariffs really crushing global trade and our global GDP, like immigration policy really putting a cap on their workforce growth.
Can you tease that out a bit? Because you talked to me a bit about that before.
Yeah, I mean, there's 13 million undocumented people in the U.S. working. they're supporting industries like construction, kind of service, lower income. I think there's two steps to this. One is they are going to really police the border. So the flow will dry up quite quickly. If they are successful, and it's really hard to see how this is going to work, but who knows, in deporting people, on top of the humanitarian cost, which would be quite awful, there's going to be labor shortages. And so that in itself is inflationary.
Right.
So you can actually start putting these things together. So if I'm a European corporate, I don't have any production in the US, I need to build production there to get around tariffs. I go invest, but now there's a worker shortage because you're reducing the supply of your workforce. That could create inflationary conditions. And so the second order impacts from all of these policies kind of happening at the same time is really hard to kind of gauge, but you got to be mindful about what the second, third, fourth order implications are as these kind of policies intersect with one another.
Yeah. Yeah, you do. How does this all play out for you in terms of where you see it in the markets? I think that we should stop there. When you think about second, third, fourth order impacts.
Yeah. So going into the election, and which is very much still our view, is we have been overweight U.S. assets, overweight the U.S. dollar, overweight U.S. stocks, have added more value, call it older economies, so finance, energy, and have really scaled back Europe and have been adding financials in Canada. That has, broadly speaking, worked out. We've trimmed a little bit onto this. Still don't really love government bonds here. And so I think we'll stick with that through the end of the year. Next year, as the bond market starts to settle, we're going to start with very, very high yields. I'm not totally convinced that we're going to see a continuation of higher yields. Look, if Trump puts forward pretty aggressive tariffs, and if Elon is successful and shrinks government, those are both deflationary. Tariffs, by putting in tariffs, it's almost like a sales tax. So if all of a sudden you and I are faced with higher costs, if no one else changes, we're going to consume less. So that's actually
different jobs. I was going to say you might shrink, very.
But the point is if we all are faced with a higher cost of things, all else being equal, we consume less by definition, or we have to borrow. And if all of a sudden you see a major impulse, and government's a huge employer, if we start to see a big impulse of government workers leaving, that's also not inflationary, it's deflationary. So again, I'll be looking at the fixed income markets in the new year to see if there's an opportunity there. But for the time being, the U.S. market is where we're kind of sticking with.